Hello everyone, welcome to Fisk Capital's series on decoding Warren Buffett's letters to shareholder. In today's video, we are talking about Warren Buffett's 1963 investment playbook. Generally, we have spoke about how Buffett started the letter, talking about the general market, then his portfolio, then highlighting some of the major investment, and also talking some operational issue of his partnerships. Since you have almost got a good gist of all these things which he talks about, in this video we are trying to focus on the key stock which he was holding in that period, and he was talking regularly about this stock for last 5 years. It was Dempster Mill and how its turnaround can help you in your investment journey. So let's begin. First of all, what he saw in this Dempster Mill unseen opportunity. As the name itself suggests, it's a mill, it's a manufacturer of farm equipment. Generally, this look very ugly business. Manufacturing firms doesn't really interest a lot of people. We have seen people are putting a lot of money in IT, in tech, in AI, in renewables, but they generally don't go in traditional industries like FMCG, retail, farm equipments, manufacturing, all these things. Same thing was the case even in the 1960s. A company founded in 1854 was facing stagnation due to outdated products, mounting inventory issue, and a lot of debt. This has led its valuation, market valuation, to get reduced significantly. And that's where Buffett found the opportunity. What Buffett did in 1963, he focused on purchasing undervalued businesses. He was continuously doing it for so many years. He always looked at company which he can buy cheaper, has the potential of transformation, and always emphasized on strong fundamentals and principle of purchasing assets at a significant discount from their intrinsic value. So he wasn't at that time very keen about growth investing and finding very growth oriented stocks. His focus was mostly on buying cheap first, getting benefit of the undervaluation, and if possible even get more returns as the company starts growing. Now what happens with this turnaround? This one particular strategy of Dempster Mill has become a landmark case in value investing. It has helped in creating a whole new series of investing, a category of investing which is called distressed securities investing, where you invest in companies which are actually going to go bankrupt, are coming at a very undervalued price, and there you found an opportunity of substantial returns, exemplifying the principle of seeking hidden value in overlooked assets. So what happens here? First of all, we have to understand the core investment principle which Warren Buffett has applied that has helped him in finding Dempster Mill kind of stock. First thing, he always believe in quote on purchase approach. He says, never count on making a good sell. Have the purchase price to be so attractive that even a mediocre sell gives. So what he means to say is that buy at such a low price that even a conservative estimate of future expectation of sell will give you a good return. You don't have to look at the rosy picture and best case scenario to actually realize the full gains you are expecting. This emphasizes Buffett's strategy of acquiring stakes at favorable prices, ensuring inherent value even if the business struggles post purchase. So even if the company does not do well, it does even worse, very conservatively it grows, still Buffett is not going to lose money. That was the first principle. Second was margin of safety versus growth projection. He used to invest in companies with an assumption that company is not going to grow. So if at zero growth projection, I am getting the share which is even attractive with zero growth projection, just its current value is lower than its price, then this is a very good opportunity for me to buy. Once he did that, he realized that there is enough margin of safety to make investment. So he don't really invest only if there is high growth probability, and in those companies he go and invest. And the final one was intrinsic value versus market price. He never invest in companies where the market price is higher than its intrinsic value. It gives a cushion to him against the market fluctuations and any errors in judgment. So even if he doesn't do a very good analysis and make some mistake in analyzing the stock, still this margin of safety can give him cushion that he won't lose a lot of money. So what happened in the Dempster Mill stock? What was the initial situation that led Warren Buffett to find the stock? In 1961, it faced a stagnant sale. They were struggling against a declining demand of farm equipment. The company was burdened with an inventory of $4.2 million, signaling operational efficiencies and misalignment of market trends. So you are seeing a company with declining growth. Generally, we completely avoid such company in our filtering, but here he found an opportunity in such a situation. Let's see how. The second issue he found was debt issue. He found that Dempster had a $2.3 million debt. Its declining asset base was further increasing the financial pressure of this debt, and this heavy debt has limited their operational flexibility and posed the risk of insolvency if the sales does not rebound. What he identified in such a situation was the market perception versus the liquidation rate. The market value of share was $28 per share. But he found that the liquidation value of the company is $35. So if he sell all the asset, pays off all the debt, still he is going to get $35, which means 20% upside even in a liquidation case. And that's why he found this attractive for investors. Now comes the turnaround strategy. He started with asset conversion strategy. Buffett executed an asset conversion. He sold the $2.3 million dead inventory and he realized 100% value from it rather than the market expectation of 16%. So he got 2.3 million by selling all the dead inventory and assets, which was not of no use to him. And this strategic move demonstrated the importance of extracting the maximum value from existing assets during a turnaround. Many times we see very good asset heavy businesses with high fixed asset, high reserve, but the companies are not being given a lot of importance because the assumption is that these assets are not going to give a lot of value. But there is also a situation here that these assets can be sold and give you a lot of money because they are very valuable assets. They are not some intangible assets. But unfortunately, many people miss this trick. The second part was debt reduction tactics. So using this $2.3 million he got from the asset sale, he reduced the liabilities. The liabilities now are much lower from $2.3 million to $250,000. This major reduction improved the financial stability of the company and returned the focus on operational performance, which was a very critical step in the turnaround process. Whatever surplus cash he was generating from the turnaround was reinvested in undervalued securities. So he was building a reserve for the company in case such hiccups comes again for Dempster Mill. So they will have a good asset base, they will have a good portfolio that can give them enough cash flow to run for a going concern. Means continuously. This strategy not only diversified Buffett's portfolio but also contributed to overall growth of the firm's value, the Dempster Mill's value. Finally, he used value growth metrics, and because of which the share value of Dempster Mill increased from $28 to $65 in 2 years. This remarkable appreciation illustrates Buffett's ability to unlock hidden value through careful analysis and strategic management of asset and liabilities. A lot of time I pay a lot of attention in companies where the financial officers, the finance team of the company is doing all the right things to increase the value of the company. I have seen a lot of companies getting a lot of money in funding at a very high level of valuation, and many people buy such company in the hope that this is going to grow further. But if you look at those companies, they are having heavy losses. Every rupee they are selling their product for, they are incurring losses on that. So the more they sell, the more losses they make. That kind of business doesn't really work. But unfortunately, people pay a lot of money for them. And where they see company with huge reserves, company with huge opportunities, or company with sensible finances, they try to ignore those kind of good companies. Are you tired of losing money in stock market? Buying at the top, selling at the bottom, following random tips and losing money? Well, stock market looks very easy, but smart investments require experience, strategy, and discipline. At Fisk Capital, we help you invest in the right. We provide research-backed recommendations, tried and tested strategies, and personalized investment plans. From small investors to big investors, from retail to HNI, all our clients trust us with all their investments. So the question is, are you going to rely on the guesswork, or are you ready to start investing with expertise? Contact Fisk Capital at the below given number and start your investment journey now. Now we have to understand what are the lessons we can learn from this Dempster Mill and how we can apply this in modern application. So the concept of investing like this in Dempster Mill is called cigar butt investing. Cigar butt strategy means investing in undervalued companies with hidden assets, likened to find a discarded cigar with one puff left. So what Buffett found was that this company is not going to have a huge growth, but this has one puff left, good asset base which can repay all the debt and make it operational for the new growth phase again. This is what he did, and he found that even though market is pricing the assets at $0.6, the actually worth of these assets and inventory is $1. And that's how he used this cigar butt investing concept. The second one was obviously risk management principles, which he always focuses on, that always invest based on margin of safety. So he invested by looking at Dempster, assuming it is not going to grow even one bit. With zero growth assumption, he found that company, even if it doesn't grow at all, he has to liquidate full company, still he is going to get more money than what he is investing in it. This is the risk management which has helped him in taking a very big controlling position in the company. How you can apply this today? You can apply this timeless principle by seeking net nets, where market cap is less than the cash on hands minus debt. If you found such stocks, these are really good distressed investing opportunities for you. You should avoid overly ambitious story stocks. Helps maintain a safety first investment approach. So basically, you shouldn't go for any company which is saying that we will have 100%, 200%, 300% growth. We will just focus on companies where even if 5 or 6% growth is there, or even 0% growth is there, still the share price which we are buying at is lower than the value we can get from this company. The final thoughts and key takeaways are that investing in an undervalued stocks or business like Dempster illustrates that price and not popularity dictates the margin of safety. So if the company is popular, famous, everybody is buying it, doesn't mean that it has a lot of margin of safety, which is my question to people saying that large caps are least risky, because not all large caps are undervalued. Many large caps are very overvalued from their prices. Second thing is Buffett's principle highlights that avoiding losses often yields greater returns than chasing for potential gains. So if you invest in company assuming that even in the worst case I'm not going to lose money, you will realize that worst case is the last thing any company wants to have. So they will work tirelessly to go for a medium to best case, and even if you are not losing money in the worst case, in the medium or best case you are actually going to make a lot of money. That's what you should always remember. I hope you like this video. Please share this with as many people as you can so that others can also learn more from this investment approaches which we are discussing in Decoding Warren Buffett series. And do share your thoughts in the comment section if you want to have similar kind of stories and strategies to be discussed on our channel. Don't forget to subscribe, and for any investment consulting, do contact us at 9039184797 or email us at sales@fiskcapital.in. Thank you very much.